adjustment. Look, it's not appropriate for me to discuss Fed policy.
Well, sir,
I don't
no
want to
disrespect,
comment
but
on.
It is. I'm not asking you to make Fed policy. I'm asking your opinion. And usually when the Federal Reserve raises interest rates on excess reserves, they're trying to contract the money supply.
No,
the reason they're trying to contract the money supply is because they're worried about inflation.
It's a purely technical adjustment. They made clear in that the stance of monetary policy has not changed at all, but because short-term overnight rates were drifting to the very bottom of their target range, they made small adjustments.
Okay. Let me stop you because I've only got a minute left. Here's my worry, Madam Secretary, and I hate to have to interrupt you, but we only have so much time. I know your job is to put the best face on it. And I understand the Federal Reserve's job is to put the best face on it. But inflation at 5% annualized gets my attention. When the Federal Reserve says, or even certain members, they say, nothing to worry about here, nothing to see, but by the way, we're probably going to have to raise interest rates sooner and faster than we thought. And when I see them raise the interest rate on excess reserves to get money out of the money supply, that tells me they're worried about inflation. And here's my question. Nobody's clairvoyant. A lot of these experts that you talked about never called the recession in 08, 09. A lot of these experts at the Federal Reserve, what if they're wrong? And the president has been adamant that he's not going to raise taxes on middle-class Americans. He's allowing that to happen right now because inflation, prices are rising higher than wages. And 5% inflation is a tax. It's a tax on food, it's a tax on energy, it's a tax on everything. And we can say it's temporary, but the actions of the Fed indicate to me they don't think it's temporary. Your thoughts?
Madam Secretary, I'm going to have to leave it at that, Senator. We'll have another round.
Well, others went over, Mr. Chairman.
What's that?
Others went over.
Actually, they went over about the same time. But let me call on.
Can I get an answer?
And the next, we'll have another round because I'm just trying to keep everything, within the fair range.
Today, the private Federal Reserve's most watched inflation indicator, the core PCE Deflator, soared to a level not seen since 1991.
Joining us now as part of our Curb Your Inflation series is Kyle Bass, Chief Investment Officer at Heyman Capital Management. Which side do you fall on, Kyle? Transitory inflation or longer lasting, potentially more worrisome inflation?
Yeah, Sarah, it's great to be here. I think, look, we're going to see a short-term turn down in inflation because the initial inflationary burst was enormous. So this transitory comment may play out to be true for a short period of time. But I think, Sarah, when you look at the money supply, the broad money in the U.S. system, from 1980 to 2010, it vacillated between 50 and 60% of GDP. And post the global financial crisis, it moved up from roughly 60 to 68, 69% of GDP. Now we're approaching 90. So in the 1 year period, 1.5 year period since COVID started, we have introduced 34% more broad money in our system in the shortest time period in the history of the United States. So we're going to see prices stay high and move higher over time if the Fed continues to expand its balance sheet, which I think it will.
This week, the Fed boosted its asset purchases and ballooning balance sheet monetization by the most it has in 3 months. Hello, on behalf of SDBullion.com, this is James Anderson with your SD Bullion Market Update. Before we move forward, please take a moment, smash the like button so this precious content can be seen by other like-minded long-term savers of real money. Silver and gold had slight climbs in spot price for the week. The spot gold-silver ratio remained at 68. A bit of bullion industry news and update. The U.S. Mint continues to sell American Eagle gold bullion coins at a potentially record-breaking clip in terms of fiat Fed note valuation terms. Whereas the Type 2 American Eagle Silver Coin program gears up for its mid-July 2021 launch for retail bullion buyers. This past week, the U.S. Mint basically admitted to its customer base on various levels of incompetence retailing its precious collector numismatic coins, while also reiterating that its ongoing supply of silver bullion blanks is limited and unlikely to satisfy ongoing demand. The Perth Mint continues to sell their gold and silver bullion coins at near record levels. Judging by the yearly price chart for gold and silver in fiat Aussie dollars, those physical bullion buyers down under are likely to see breakouts into new record spot price territories for both respective monetary metals sooner rather than later. The Central Bank of Poland made news in gold this week, citing aims to acquire another 100 metric tons, or over 3.2 million ounces of gold bullion for the nation's reserves over the coming years. While likely to, Poland being part of the European Union, will be forced to accept the coming fiat euro central bank digital currency. But by their gold bullion buying actions over the last few years, Poland likely wants more influence over the coming structural financial reset terms. Turning to the ongoing Fiat Federal Reserve's financialization run amok, the ongoing denial by the Federal Reserve that its running bailout policies are not exacerbating the wealth gap have become nothing short of public farce. Not merely in funny college professor Twitter polls, but also in the damning data we're about to look at. In 2011, Credit Suisse estimated that the USA had just over 35,000 estates with over $50 million in net worth. Now updated through the end of 2020, that figure has now nearly tripled. Over 110,000 estates with over 50 million fiat Fed notes. Phony crony capitalists might want to read a few history books and then pause to wonder, has the U.S. middle class tripled in size over the last decade? Here's a general scorecard highlighting asset performance rampings since the 2008 global financial crisis. Now, my ongoing bets are gold bullion, silver bullion, and commodities will receive large portions of the wealth gains transferred in this decade unfolding. Following up on last week's Paul Tudor Jones comment on CNBC about the current $88 trillion in assets under management, the following clip from our March 2021 video entitled What It Takes to Be a Silver Bullion Whale highlights about 3.75% of those $88 trillion in funds being managed typically by family offices for the high net worth crowd with net worths of over 30 million fiat Fed notes. Have a listen. This right here is great precious metals related data. It's based on responses from 620 private bankers and wealth advisors managing more than 3.3 trillion of wealth for ultra high net worth investment clients. The survey ran during October and November 2019. That's pre-pandemic fiat currency bailout explosions. The following question was asked. On average, how are your clients' investment portfolios allocated to the following asset classes? Now you could read all the fine details here, but if you look over at the precious metals gold section, you can see how pathetically tiny the highest net worth are positioned in their underlying fiat currency positions, especially if their underlying fiat currency positions really start to go wrong. I mean, you imagine if the fiat currencies really go wrong, these people are going to freak. Remember, too, that they are likely positioned in unsecured underperforming ETFs like SLV, SIVR, GLD, IAU, COMEX futures, etc. It's totally different than actual physical bullion. They and possibly their money managers are totally clueless to the risks they're actually running by using their allocations in that way. But hey, they're going to learn the hard way eventually. Important to remember also that pension and endowment funds notionally still have next to no precious metals exposure yet, and that is why the investable gold allocation percentage on this chart, updated through 2020 on the right-hand side, remains so tiny. My expectation is once this bullion bull has arrived to its manic phase, the old 2011 high here will be well past, and we'll be heading back towards the old 1980 investable gold as a percentage of global financial asset heights, seen on the far left-hand side of this chart. Now, speaking to those who are considering adding to your bullion positions at the moment, looking at the 200-day moving averages for gold and silver throughout this full fiat currency era, if you believe this is a building secular bull for bullion, I would look at the bottom of these charts when the 200-day percentage deviation tracker gets near or below the red horizontal line it's usually a good time to be acquiring. Look back at the second half of the 1970s and the 2000s for part of my reasoning in saying so. In terms of spot prices ongoing, the technical cup and handles that both gold and silver are currently building, they should have explosive upside power in the not too distant future. Now finally, to end this week's SD Bullion update, I want to give you a quick preview of the conversation I had this past Tuesday with the Silver Fortune YouTube channel. I'll leave the full 1-hour link in the comments and video description below if you care to have a full listen. But what I told his channel and listeners there from the start of the interview about recent price action in silver and gold, that's not changed over the last few days since, so have a listen.
The first thing I would say is the spot price, it's been boring of late. I know that for sure. It's almost, when August comes around this year, it'll be 1 year if we're still within this trading range between 30 and 25, 24 roughly spot. But it's technically a good thing because what you're doing here technically is you're building a base for a launching pad to go higher eventually. And the bigger the base, the bigger the move. So, if this goes on sideways for much longer, it just helps eventually for the the higher move ahead. And I just think what we've done in terms of Federal Reserve policy, in terms of expanding the monetary base, the actual Fiat M0 monetary base is essentially doubled since the pandemic came about. And if you look at the M1 definition, they changed it. M1 definition now also has savings accounts in it. And so it's almost the exact same as the M2 count. So M1's like 19 trillion, M2 is 20. The monetary base is over 6 trillion. And I don't see any reason why it's going to be stopping in the years coming. I think that we're walking into probably another financial crisis at some point this decade, where you're going to have a lot of institutions fail, I think, or get bailed out or get consolidated or bailed in or what have you. But this is not over. The storm is still ahead, I think. And, the pandemic was the precursor, but I still think there's a bigger thing probably coming in terms of the financial reset of the structure in the system. So, it's a long-winded answer, but the bottom line is that silver is in good stead. I think it's fine. The way it's traded in, last few days, obviously it was down a few dollars. I thought the move in gold was more shocking psychologically for people from, it was trading over 1900 and back down to 1775 roughly. So that was a pretty big move when you move $100 that quickly, all on a bunch of nonsense. I mean, the Federal Reserve came out and what they say, they said, nothing's changed and we may raise interest rates in 2023, maybe look at our dot plot. Yeah, we might do that. I mean, it's insanity. And then the entire time they're talking about this inflation's transitory. The jury's still out on that, but I think ultimately most people who go to the grocery stores and such know that prices have been rising for a lot longer than they've been telling the truth about. If you use the old 1980 way to measure CPI, we've been running around double digits for decades, it seems. And they've been telling us that there's no inflation. So it's basically what the capital class, the elite class is going to tell you because they're the ones winning. They're the ones getting handsomely rich while everybody else is sitting there listening to a bunch of lies, basically.
That's all for this week. Hit the comments section below for the link to hear that full new interview. And as always, you out there, take great care of yourselves and those you love. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.